So now the time is 11:05. Officially, we are supposed to get into the session. But before that, any first-time attendees here? Any of you are attending for the first time? We have Danu from Dubai. If any of you are attending for the first time, just type FT, first-time attendees. Yeah, Nijantan is attending for the first time. Harsha, first-time attendee. Timareddy, Shahrukh, Gayatri, Babaditya, uh, Harish Babu, Edela, Saurabh Kumar, Neha, Haribabu, Vinti, Srinidhi. Okay, so we have so many first-time attendees as well. And any diamond members are here? Any diamond members? If you're a diamond member, just type diamond. Narendra Kumar, SK, Prashant Pradeep, Haribabu. Any diamond members here? If any diamond members are attending the session, please type FT. Sorry, please type diamond. Please type diamond. Wow, we have Danub, Abhi, Srinivas, Pallavi. Okay, diamond members. And diamond members, I hope you know this is basically a foundation setting session where we are going to revisit the fundamentals in financial ratio analysis. Of course, you have access to advanced discussions in your diamond membership, but this is a foundation setting session, and I believe this will be a refresher session for you as well. Yeah, we have Kuldeep Rana, diamond member, Viswajit, Haribabu. Okay, so now it's time for us to get started. Let me share my presentation screen. Just let me know whether the screen is visible. Okay. I hope the screen is visible for all of you. Yeah, Mohammed, thank you so much. And now let's get into today's session. But with the permission of the Diamond members, I'll just take 1 minute time to give a quick introduction about myself because we have lot many new members as well. So you are seeing me on screen. I am CA N Raja, a chartered accountant by qualification, a teacher, trainer, a coach by passion. I started my career with State Bank of India, where I joined as credit analyst. I worked with State Bank of India for a period of 4 years. In very short period after joining as credit analyst, I was elevated as team leader of credit processing cell, where I had opportunity to work on loan proposals starting from the ticket size of 10 crore to 500 crore. So over a period of 4 years, I actually worked on 250 plus projects, which is 5,000 crore plus size. So this was the extensive exposure I gained in State Bank in credit and financial analysis. Then I came out and started my CA practice. And during my practice days also, I focused on project finance and debt syndication as my core practice areas. Parallelly, I also took up teaching assignment. I used to teach financial management and strategic financial management for the students who are pursuing professional courses like CA, CMA, CS, and so on. Then I also started teaching through online platforms like this. So thanks to the technology, today we have 3 lakh plus learners learning credit and financial analysis through our structured online courses across 180 plus countries. So this is my quick background. And with this, let's get into today's session. Yeah. So this is a foundation setting session for financial ratio analysis. This session can be an eye-opener for those who are attending for the first time, and this can be a refresher or revision for those who are attending it for the second time or so. Okay, so Diamond members, for you, it's going to be a repetition, but I believe that it will add value for you. So to get started, let me give you two scenarios. Okay, let's say there are two companies, A and B. Company A has reported a profit of let's say 5 crore, and company B has reported a profit of 10 crore. Now, with this limited information, I know the information is very limited. With this limited information, if I ask you which company is more efficient, what will be your answer? Is it the company making profit of 5 crore or the company that is making a profit of 10 crore? Which company you will agree as an efficient company? Please give your answers. Yeah, I could see Stowe is saying it's company B. Gayatri is saying it's company B. And I know the information is very limited. You may have some reservations to answer. So open up your mind. Okay. If you believe it is B, type B. And if you believe it is A, type A. And if you believe the information is inadequate, you can't frame an opinion, you just say that also. Okay. Yeah, let me see. Let me see. Okay, I started getting answers. Gayatri Stoy said in favor of B. Neha in favor of B. Babrao and Vivek voted. Timaredi voted in favor of A. Rajendra is of the opinion. I mean, Rajendra Meena. RK Meena, right? We discussed. We had some WhatsApp conversation. RK Meena of the opinion, I can't say anything now. Haribabu is saying B. Ahmad rather is of the opinion, I cannot come to a conclusion by looking at this. I need to see the cash flow statement. Kuldeep Rana is of opinion it's B, and Amar is B, but Amar also has got some reservation. Ajas is unable to come to any conclusion. Srinivas is saying it's B. Unmukt, inadequate information. Nijantan is of the view inadequate information. Mohammed B. Saurabh can't decide. Manoj is of the opinion we need some more information. Abhi is also of the opinion we need some more information. Yeah, what about others? Just type A or B. Just type A or B. So what I could see now is we have Khalil saying we have to look into other factors as well. So based on the reply received, the majority of the answers were in favor of B, and many of you also said the information is inadequate to come to a conclusion. We need some more information. So I respect both. Whoever said B, I respect that, and whoever said they need more information, I also appreciate that. Okay, so to help you to make a thorough analysis, I'm going to give you that one more piece of additional information. That is, sales achieved by the company A is 25 crore and sales achieved by company B is 100 crore. So now you have one piece of additional information, a comparable information. Now tell me which company is efficient here. Is it company A or company B? Okay, now answers started pouring. Stoic, Gayatri, Srinivas, Suvida, Saurabh Kumar, Narendra Kumar, Danub, Unmukt, Mohammed, Vikash, Harsha, Rajendra Meena, Vivek, Baburao, Ajas, Khalil Yunus, Rudrani, Sachin, Shahrukh, Babatya, Parasuram Hai, Nijantan, Karthik, Vikram, Neha, everyone is in favor of A now. Everyone is in favor of A now. Hey, what happened here? Earlier, majority of you were in favor of B and many of you were of the opinion information is inadequate. But now, what forced you to change your decision from B to A? That too, when you got this additional information, what actually made you to change your mind? What made you to change your mind? I think you did some kind of an analysis, probably something similar to this. You compared 5 crore profit with 25 crore, and you understood that this 5 on 25 represents 20%, right? Then I think you also compared 10 crore with 100 crore, and you concluded that it is only 10%. So this made you to compare these two. That is, company B is making only 10% profit margin, whereas company A is making 20% profit margin. It means if company B is making a sales of 1 rupee, okay, if they are making a sales of 1 rupee, they are capable of making profit of only 10 paise out of it. 10 paise out of it. But if company A is going to make a sales of 1 rupee, they are able to make a profit of 20 paise out of it. So I think you went to the grass level of comparison and it actually makes sense. Is it not? Because the sales 1 rupee in both the cases it is same. But company A makes only 10 paise profit. It means 90 paise goes towards expenses. Whereas company B makes 20 paise profit. It means only 80 paise goes towards expenses. That means they are making 20% profit margin, which is greater than 10 percentage profit margin. And I believe that's the reason majority of you concluded company A is better than company B. So the kind of analysis what you have done here is called as profitability analysis. Is called as profitability analysis, where you just did only one part. Profitability analysis is a big area where you just did only one part. That is, you compared the profit with the sales, and in order to express that as percentage, we have to multiply with 100. So this basically gives you what is known as profit margin. And this is actually a ratio. This is actually one of the financial ratio which is widely used by the key stakeholders. Key stakeholders, whoever going to evaluate a business, they will look into this ratio. They will look into this ratio to understand how efficient the business is able to make profit out of the sales. Are they making 10%, 20%, 30%, or are they losing money, or are they making only thin profit? Okay. So this is one of the widely used ratio, and I believe you all have did this analysis, whether you are aware of this ratio or unaware, but this comparison helped you to take a decision. And let me tell you, that's the power of ratio analysis. That's the power of ratio analysis. Why I'm saying it is a power of ratio analysis? Because earlier, when you took decision based on raw data, that is when you are just given the information about the profit and nothing else, many of you were actually inclined towards B, and many were of the opinion information is inadequate. But many sided B because you are taking information by looking at the standalone. Sorry, you are taking decision by looking at the standalone information. In finance, never ever take a financial decision by looking at the standalone numbers. You have to compare them. You have to compare them with the relatable parameter. Here, profit can be compared with the sales, which is a relatable parameter. And when we compared it, it gave us an additional information. Yes or no? When we compared, it gave us an additional information. And that additional information helped us to take what is known as meaningful decision. Meaningful decision. And that's the actual role of the financial ratios. That is, it should give you additional information so that you can take meaningful economic decision. Here, changing your decision from B to A was actually facilitated only because of the ratio called profit margin here, only because of the ratio called profit margin. Okay, so this is the backdrop I want to set today to kickstart our session. Is this clear? Whether my message is loud, clear, and straightforward? If everything is clear and if you are ready to jump into the session, just type start. Just type start so we can deep dive. Yes. Thank you. Thank you so much. Wonderful. Wonderful. Let me also give you one more piece of analysis. Okay. Now look at this. There is a company. Let's say the name of the company is X Limited. In 2024, they had, let's say, current assets of 30 crore. In 2025, their current assets is 100 crore. So here the information what I'm supplying is current asset. If any of you do not know what is current asset, these are all the assets which can be converted into cash within a period of 1 year. So they may be in the form of cash itself. They can be in the form of deposit. They can be in the form of inventory, goods. They can be in the form of money due from customers. But all those assets can be converted into cash within a period of 1 year. So we call them as current asset. Okay. So now my question is, in 2024, they had 30 crore of current asset. In 2025, they have 100 crore of current asset. In your opinion, in which year they appear to be more comfortable? In which year they appear to be more comfortable? Is it when they had 30 crore of current asset or when they have 100 crore of current asset? In which year they are more strong? Is it when they had only 30 crore or when they have 100 crore? I mean, do not get into deeper analysis just because I have given only the limited information. I've given only the limited information. Look at this information and what comes to your mind. Okay, we'll do deeper analysis after this. Yeah. So let me see the responses. Saraswati is saying 2025, Surya Narayana 2025. We have Nijantan and Yunus favoring 24. Ajas, more information needed. Vikas 2025. Imithias 2025. Krishna Prasad, Harsha 2025. We have one or two participants, Neha and Haribabu 24. Amar Sachin 25. Mohammad Ashish 25. Then Gayatri 25, Kuldeep Rana 25, Bhagwat 25. Vivek is of the opinion more information is needed. Okay. Stoy unable to ascertain, Yashwant Kumar 25. So here also what is happening is majority of the participants are favoring that in 2025 this company appears to be more comfortable or more stronger because they have 100 crore of assets. Earlier they had only 30 crore. It means there is a growth of around 70 crore. So they have grown big. So it appears that in 2025 they are stronger, they are more comfortable. But as I told you earlier, we cannot come to a conclusion just by looking at the standalone numbers. Here, this is the standalone number. Here, if at all a comparison can be done, it is only the growth. That is from 30 crore, this has grown by 70 crore. So it is 100 crore, but no other comparison is possible. But in finance, if you want to take decision, you need a comparable information. So for that, let me give you one more piece of information. One more piece of information, that is the current liability. Current liability means these are all the liabilities that have to be repaid within a period of 1 year. Current assets means they can be converted into cash within a period of 1 year. Current liability means these are all the liabilities that have to be repaid within a period of 1 year. Okay. Now look at here. In 2024, their current liability is 15 crore. In 2025, their current liability is 120 crore. 120 crore. Okay. Now tell me in which year they were comfortable. Is it in 2024 or 2025? Okay. Answers started pouring. Yeah. Nijantan 2024. Okay. Harsha 24. Vikas 24. Mithyas, Saraswati, Krishna Prasad, Saravanan, Mohammad Wasim, Yashwant, Narendra Kumar, Babu Rao, Khalil Yunus, Gayatri, Srinivas, Ajas, Manmit, Sachin, Haribabu Vinti, Danub, Kuldeep Rana, Purna Chandra Rao, Rudrani, Vivek, Amar. The gap is going. The gap is going. Rudrani, yeah. Karthik, Amar, Saurabh Kumar, Ashish, Sarfraz Alam. Very good, very good. So now majority of the participants, I think no one talked about 25 or only one or two participants. Yeah. Now the majority participants are saying that it is in 2024, they appear to be more comfortable, more stronger. Why is that? It's because in 2024, they had obligations of 15 crore that have to be settled within a period of 1 year. And for settling the obligation, they had resources in the form of current assets. It means for paying 15 crore, they have 30 crore with them. This 30 crore may be in different forms, but they can be converted into cash within a period of 1 year. And with that, they can pay off this 15 crore. But in 2025, you see what happened? Within 1 year, they have to pay 120 crore. And for paying 120 crore, what they have is only 100 crore. It means they are staring at a shortage. They are staring at a shortage of 20 crore. They are staring at a shortage of 20 crore. And I believe you did this analysis. You did this analysis. You compared 30 with 15. You are comfortable. The resources are twice of the obligation. You compared 100 with 120 and you concluded that resources are not adequate. So let me do that comparison here. I compare 30 with 15. I put the 30 in the numerator, 15 in the denominator. I get the value as 2. And I write it as 2 is to 1. And you know what does that mean? For every 1 rupee of the current liability, this business is having 2 rupees of current asset. So with this 2 rupees, paying this 1 rupee is easy. And even after paying that 1 rupee, the business will be still left with 1 rupee of current asset, which will help them in running their day-to-day operations. But if you look at 2025, they have current assets of only 100 crore for settling 120 crore. So 100 divided by 120, what is the value? Please tell me. 100 divided by 120, it is 0.83 only. It is 0.83, and we will express it as 0.83 is to 1. It means for every 1 rupee of the current liability, they are having a current asset or resources of only 83 paise. It means even for settling 1 rupee, they have shortage of only, they have shortage of not only, they have shortage of 17 paise per rupee of obligation. Shortage is good or bad? Shortage is bad. For settling 1 rupee of current liability, they have current assets of only 83 paise. That is, even for settling 1 rupee, they are having a shortage of 17 paise. They are having a shortage of 17 paise. And it's because of this reason we consider that 2025 they are not comfortable. Yes, they are not comfortable. Their dash position is strained here. I'll explain what it is. Their dash position is strained, and here dash position is comfortable. That is, and for that the answer is liquidity. Yes, the answer is liquidity. It means in 2024, their liquidity position is comfortable. So what do I mean by liquidity? Liquidity means ability to meet the short-term expenses, short-term obligations without any difficulty, In 2024, do they have any difficulty on the liquidity side? No, because they have to pay 1 rupee, they have 2 rupees with them. It means their liquidity position is comfortable. Whereas in 2025, they have to pay 1 rupee and they have only 83 paise on hand. It means they are having a shortage of 17 paise per rupee of obligation. Their liquidity position is strained. So look at here. Let me just give you these numbers once again. Current ratio of 2024 is 2:1, and of 2025, current ratio is 0.83:1. Now, just by looking at these ratios itself, I can come to the conclusion that in 2024, they are comfortable. In 2025, they are not comfortable. Yes or no? Without even looking at the big numbers, that is 100 crore, 120 crore, or 30 crore or 15 crore, without looking at big numbers, just by looking at this ratio, I can come to a conclusion that for paying 1 rupee, they have 2 rupees. They are comfortable. For paying 1 rupee, they have only 83 paise. They are not comfortable. Yes. And that's the power of ratios. That's the power of ratios. And that's why financial ratio analysis is considered as one of the important tool in financial analysis. Okay, now let's go little deeper. So now we understand that ratios means they are basically a relationship between two numbers. Okay, that relationship should be created in a logical way. Only then we can make use of the ratios. And ratios can be broadly classified into 4 categories. One is liquidity ratios. Two is capital structure ratios. Three is One is liquidity ratio, two is capital structure ratios, three is profitability ratios. Okay, capital structure or solvency we can call it. Three is solvency ratios, and four we call it as efficiency ratios. Okay, efficiency, or we also call it as turnover ratios. Now, liquidity ratio basically deals with liquidity. We had some preliminary discussion related to that. And in that only, current ratio comes. So already I have introduced what is current ratio by now. We'll talk a little more about this shortly. Then comes the capital structure ratio, where we will be understanding the long-term stability of the business, whether a business can be stable in long term or not. And this is one of the important ratios. Every lender, every banker, they pay key attention to this particular ratios. And profitability ratios are multiple in number. One set of profitability ratios where profit will be compared with sales. In another set of profitability ratios, profits will be compared with investments. Okay, so here profit being compared with the sales, we call it as general profitability ratios. We call it as general profitability ratios. And in that angle only, I introduced the first ratio where we compared the profit with sales and we multiplied it with 100. Okay. Then comes efficiency ratios, where there are multiple ratios, turnover ratios and all. And today in this session, we will focus more on this. We will cover this as well. This already I touched. Okay. So we will be focusing on all these areas. I may not be able to take up this today because they are all very lengthy, detailed discussions. But we will focus more on this, which is considered as fundamental and very important in ratio analysis. Now, a question may arise: why banks have to pay so much attention to liquidity ratios? Okay, why banks have to pay so much attention for liquidity ratios? Now, just tell me, look at the scenario. Let's say a company has approached you for a loan. A company has approached you for a loan. They are already running business. They are making 10% profit margin. Okay, this is a company already running. They are making 10% profit margin. They have asked a loan from your bank. Your bank has also given the loan. And with the loan, they have put up a project, and that project clicked. It worked very well. And because of that, the profit margin of the company moved from 10% to 25%. Earlier, they used to make only 10% profit, but now they are making 25% profit. And let's say this loan was given at the rate of 12%, 12% interest. Now, look at here, the profit of the business has jumped from 10 to 25%. It means that customer is making additional profit of 15%. Now, if that customer is making additional profit of 15%, will he pay additional interest to the bank? Will he pay additional interest to the bank? Because it's because of the bank money only he has put up the project, and because of that he is able to make more sales, he is able to make more profit. But my question is, since because he put up the project with bank loan, and since because he is able to make more profit, will he pay additional interest to bank? All of you, please think and tell me, will he pay additional interest? Answer is absolute no. He will not pay additional interest. Why? Because already both banker and the borrower has gone into an agreement where the interest will be only 12%, let whatsoever may happen in the business. So if a business is going to make more profit, banker is not going to get any additional share. But let's say instead of a project becoming success, it is landing into failure. Earlier, they were making 10% profit. Now the project failed terribly. And because of that, instead of making profit, this business started reporting losses. And they are not making enough cash to pay interest. So they are defaulting. They are defaulting in payment of interest and principal. Let's say the security is also not fetching any value. Okay, no value, or they are not enforceable, or they are fetching only less value than expected. In that case, the bank is exposed to loss. Yes or no? In that case, the bank is exposed to loss. Yes or no? Just tell me. Yes. in that scenario, the bank is exposed to loss. Look how contradicting it is. When the borrower makes more profit, bank will not get any additional profit. But if the borrower suffers loss, bank also has to suffer loss. Yes or no? When the borrower makes more profit, bank is not going to get additional profit. But if the borrower suffers loss, bank is also put to loss in many occasions when the security is not adequate enough. So this actually changes the focus of the bankers from profitability. Are you getting me? So bankers are not enticed, bankers are not excited when a business makes super duper profit. Why? Anyhow, they are going to get only this 12%. So what is the point? If they make 25%, what they get? Nothing, only 12%. If they make even 50%, what they get? They get only 12%. So they're not at all enticed or excited about the super duper profitability of the business. What they are particular, they want to ensure they are not put into loss, because anyhow you guys are not going to give anything in profit. So at least let us safeguard ourselves that we are not going to get into the loss. And in order to ensure that they are not going to get into loss, they focus more on liquidity analysis. Okay, they focus more on liquidity. They will see whether the business is having adequate current assets to pay off the current liabilities, because bank obligations, all the obligations will come and sit under current liability. So if the current liability have to be paid, bank should have adequate corresponding current assets, only then bank will be able to get back its interest, get back its principal. Okay, so banks always, they put their primary focus on what? They put their primary focus on liquidity, and it's because of that reason, ratio called current ratio has significant place in the analysis, Okay, so if you are a banker, what should be your ultimate focus? Tell me, if you are a banker, what should be your ultimate focus? Let the profitability be there, but your ultimate focus should be, please comment, your ultimate focus should be whether the business is liquid or not. Because if the business is not liquid, there is no point in making profit also, because only liquidity, only current assets will be available for paying current liabilities, and the bank loans are part of current liabilities. Bank loans are part of current liabilities. Okay, right? Right. So liquidity position, yeah, like Harsha mentioned, liquidity position is very important. Only then the loan can be recovered. Okay, now how to understand this liquidity? Let's go little deeper. Okay, I'm drawing a balance sheet here. See, in business, funds can come from various sources, right? Funds can come from various sources. Let's say owners are bringing in funds. Let's say owners are bringing 10 crore. And in business, profits are retained. Whatever the profits made, many of the profits are retained. Let's say that is around 15 crore. Business also raising term loans, a long period loans. Let's say that is around 25 crore. And suppliers are giving credit. I'll say supplier credit. Let's say that's around 10 crore. And bank is also giving cash credit facility. That is around 15 crore. So look at here, what is the total funds raised? 75 crore. 75 crore worth of funds has been raised from various parties. And these funds are used for, let's say they are used for acquiring asset like land, building, machinery. Okay. So all this we can call as non-current assets. Why we are calling it as non-current assets? Because they are not acquired with an intention to convert as cash. Because I gave you the understanding of current asset means those assets which can be converted into cash within a period of 1 year. But if a business is purchasing land, building, machinery, they are not purchasing it with an intention of selling it tomorrow or within 1 year. Rather, they want to use it for a longer period of time. Okay, so this 75 crore used for acquiring non-current asset, and they are also used for acquiring current assets. Let's say current assets are in the form of inventory, that is goods, They are in the form of receivables, right? Let me give some number. Let's say, just a moment. 15 crore is the cash credit plus 10 crore is a supplier credit, right? Okay. So let's say around 35 crore, or in the form of current assets and 40 crore or in the form of non-current assets. So totally it is 75 crore. Okay. Now let's do some small bifurcation as to how these funds have come, from which sources it has come. Please tell me, who is contributing the capital? It is coming from owners, right? So this is owners' money. This is owners' money. Owners' money. Yeah. Reserves and surplus. What is the reserves and surplus? These are all the profits earned by the business, reinvested inside the business itself. It means instead of reinvesting, ideally these should have been distributed to the owners, right? Because owners are entitled to profit. These are all profits reinvested inside the business itself instead of being distributed to the owners. So who is ideally eligible for this money, reserves and surplus? Who is the claimant for this money? Please answer. These money ideally should have been distributed to the owners. So I can say this is also owner's money. Owner's money. Harsha, not bank money, owner's money. So look at here. Out of 5 different funds, 2 funds have come from owners. One has directly come from the pockets of the owners. Pockets means owners have given the money this. Okay. Reserves and surplus are supposed to go outside the business, but it has not gone outside the business. That got reinvested within the business. Okay. But the claimant for that money is also owner. So these 2 funds, that is 10 plus 15, 25 crore has come from owners directly and indirectly. Okay. Now, term loan. Who is giving this term loan? Banker. Supplier. Again, the name itself clear. And bank. So this has come from outsiders. Term loan has come from outsider. Supplier credit has come from outsider. Bank cash credit is also from outsider. So what does that mean? We have another set of funds which has come from outsiders. That is term loan, supplier credit, bank credit. 25 plus 10, 35, 40, 50. 50 crore has come from outsiders. 25 crore has come from owners. Is this clear? Just type clear because I'm going to change the pattern now. So far, is it clear? Funds have come from owners. Funds have come from outsiders. But if you want to do liquidity analysis, this bifurcation will not help. If you want to do liquidity analysis, this bifurcation will not help, but it will help you somewhere else, which we will cover in today's session itself. So if you want to do liquidity analysis, you have to focus on timing of the fund. You have to focus on timing of fund. Shaunak, yeah, Shaunak, correct. Director's unsecured loan. Director's unsecured loan, if it is considered as quasi-equity, then we can treat it as owner's fund. Otherwise, it has to be seen as outsiders funds. Okay. Now listen, for liquidity analysis, the focus is timing of fund. Whether the funds which had come is a short-term fund or long-term fund. That's it. Okay. Now, please answer me. The money which has come from bank cash credit, which is repayable within a period of 12 months, is it short term or long term? Just type ST or LT. Just type ST or LT. This is short term. Supplier has given a credit which have to be repaid within a period of, let's say, 30 days, 60 days, or 90 days. Short term or long term? It is short term in nature. Okay. Then there is a term loan. There is a term loan. Let's say bank has given a term loan for a period of 5 years. It is long term. The reserves and surplus and capital, which are payable to the owners only when the business is closed, only when the business is closed, short term or long term? These are long term. Okay. So now what we have done is we have classified the funds on the basis of time. So what we have is we have 3 long-term funds and 2 short-term funds. This business has raised 3 long-term funds and 2 short-term funds, right? What is 3 long-term funds? Capital plus reserves and surplus plus term loan. All three put together, how much? It is 50 crore. It is 50 crore. And what is the short-term fund? Supplier credit and bank credit. 10 plus 15, it is 25 crore. Okay. Now let's put our focus on the asset side. They have purchased non-current assets. They don't have any intention to sell these assets within a period of 1 year. Are they long-term or short-term? These assets, are they long-term or short-term? They are long-term assets. They are long-term assets. Okay, good. Current assets, they've acquired inventory, they've acquired receivables, and all these are done with an intention to convert them into cash within a period of 1 year. Long-term or short-term? These are short-term assets. Okay. So now let us group the assets. Let us group the assets and liabilities. So this is the grouping. So this is long-term sources. This is short-term sources. And look at here. There is a long-term asset, short-term asset creation. Now, are you able to make something out here? Business is raising long-term sources for creating long-term assets. Yes or no? Yes or no? Business is raising long-term sources for creating long-term assets. Business is raising short-term sources for creating short-term assets. Look at the beauty. Okay. Yeah, Yashwant has a valid observation. I'll come to that, Yashwant. So now what we can infer is business can raise long-term funds. Probably I'll put here. Business can raise long-term funds. They can use it for creating long-term assets. They can raise short-term funds and they can use it for creating short-term assets. Okay. Let me give you a discipline guide now. Let me give you a discipline guide. The discipline guide is something like this. If a business is raising short-term fund, and if it is using that for creating short-term asset, then that is good actually. If a business is raising short-term fund, and if it is using that for creating short-term asset, it is good. Are you all with me? It is good. If a business is raising long-term fund and using it for creating long-term asset, then that is also good. Okay. And let's say the business is raising long-term fund and using it for creating some short-term asset. If a business is raising long-term fund and using it for creating some short-term asset, then I would say this could be best. This could be best if it is as per design. If it is as per design. What do I mean by that? Look at here. Somebody already noted, right? Yeah, look at here. Here, the long-term funds, what they have raised is 50 crore, right? 10 plus 15 plus 25. But what they have used for long-term purposes only 40 crore. 50 crore has been raised, only 40 crore has been used. I'll mention that over here as well. The long-term funds, what they have raised is 50 crore. And what they have used is only 40 crore. So what happened to the remaining 10 crore? Where did the remaining 10 crore went? If 40 out of 50 is spent here, the remaining 10 should go over here. Yes or no? Yes or no? Because that is the only source, right? 40 is spent here. The remaining 10 should ideally go over here. Okay. Now listen. The remaining 10 has gone over here. Let me put that 10. Okay. And let me just come back and pick up these numbers as well. What is the short-term funds they have raised? They've raised 25 crore. Is it not? 10 plus 15. This 25 crore was the short-term funds they have raised. So let me put that here, 25. And what is the short-term asset they have created actually? The current asset, they have created 35 crore, right? So let me put that here, 35 crore. And now can you picturize how this 35 crore asset was created? How this 35 was created? This 35 asset was created using this 25. Yes or no? This 35 is created using this 25 and the remaining 10 from here. Are you all with me? Just type with you. Just type with you because you are going to get the greatest learning now. Okay. Now listen. So this 35 is created as a result of 10 from long-term funds and 25 from short-term funds. This is short-term fund. This is long-term fund. And now they have 35 crore with them. And you know what is the beauty of this 35 crore? What is the beauty of this 35 crore? This 35 crore can be converted into cash within a period of 1 year. Yes or no? When they convert the 35 crore within a period of 1 year into cash, they have to settle 25 crore. Yes or no? This has to be settled. Yes or no? Yes. When they convert the 35 crore as cash, they have to use that to settle these guys. But remaining 10 crore, should they settle? Remaining 10 crore, should they settle? No. There is no compulsion to settle. Why? Because it has come from long-term funds. Now let me tell you the beauty of it. Let's say this 10 crore, which has come from long-term funds, is used for creating inventory and receivables. Okay. So if you are going to invest 10 crore, then for sure it will generate some profit also. Yes or no? Because this 10 crore is the investment using which you are going to create inventory. You will make it as finished goods. You will sell it to the customer and you will get the cash back. And when you get the cash back, it will come with profit as well. Yes or no? Are you all with me? This 10 crore which has come from long-term funds is invested in the inventory, in the finished goods. They are used for producing the products which are sold to the customer. And when customer pays, you will also get the profit. Let's say this 10 crore is going to help this business in making a 10% return, that is making 1 crore profit. It means if the 10 crore is invested in this process, they will get back their cash as 11 crore. They will get back their cash as 11 crore because they are investing in their core business. So what is the profit they are making here? What is the profit they are making? The profit is 1 crore. And let's say this process takes 45 days time. This process takes 45 days time. That is, they put the inventory 10 crore and in 45 days, it is produced and sold and cash is collected from the customer. In 45 days, this 10 crore is becoming 11 crore. They are making a profit of 1 crore. So when the 11 crore comes, do they have the compulsion to pay back the 10 crore? Do they have immediate compulsion to pay back the 10 crore? Yes or no? No. I hope all of you are with me. Okay. And in one cycle, what is the profit they made? That is, in 45 days, one cycle, they made a profit of 1 crore. It means on 46th day, they can reinvest this 10 crore. They can reinvest this 10 crore, which will help them to make another 11 crore, which will help them to make a profit of another 1 crore. Yes or no? Yes, it means they can go ahead with one more cycle. So another 45 days. So in 90 days, what is the profit they have made? What is the profit they have made in 90 days? They have made a profit of 2 crore. In 180 days, what will be their profit? In 180 days, the profit making capability is 4 crore if the same cycle is repeated. And if it is repeated 8 times, that is for 360 days, it is going to be 8 crore profit. It is going to be 8 crore profit. And you know why all this happened? It all happened because this fund has come from long-term sources. Imagine if this fund also had come from short-term sources, then the moment this company makes 35 crore, they have to settle off. Or within a period of 1 year, they may not have opportunity to repeat the cycle. That's why I said raising long-term funds for short-term purpose is best if it is as per design. Here, they have raised 50 crore. They are aware their long-term requirements is only 40 crore. They've raised another 10 crore basically to support the short-term asset creation, because they know if they invest in short-term asset, that will give them the ability to make more profit by repeating the cycles again and again, at least 8 times in a year, at least 8 times in a year. So if it is as per design, then using the long-term funds for short-term asset could be the best thing an organization could do. Okay. But the worst thing is, if it is not as per design, then that will be a diversion. Abhi, I'm coming to your point. Okay. See here, when I say long-term funds, it can be from various sources, because what are the items we have classified under long-term funds? Owner's money, retained profits, term loans, right? These three are long-term funds. Owner's money, owners, do they need anyone's permission to use their capital in investing short-term assets? Yes or no? Tell me. Owners, do they need anyone's permission to use their money for investing in short-term assets? Answer is absolutely no. Owners, do they need anyone's permission to use their profits, for investing in current assets? No. But if they are going to use term loan for investing in current asset, and if it is not as per design, then they are actually committing a mistake. Let's say, for example, the bank has given a term loan for purchasing plant and machinery. And if that money is diverted for investment, then that is bad. Are you all agreed? If a term loan has come for purchase of specific plant and machinery, so instead of using that money in purchasing the machinery, if that is diverted for current asset, then that is a diversion. Then it is not as per design. I always maintained as per design. Here it is not as per design, because here the design is ideally this money is supposed to go to machinery, but you have changed the design. That is not acceptable. Okay. So if this is happening, this could be the best thing that could happen for a business, because business will get a lot of opportunities to repeat the cycle. Especially if it is a profit making business, then it could be the best thing. They can have disproportionate profit making capability, right? So we have understood that using short-term funds for short-term purpose is good. Using long-term funds for long-term purpose is good. Using long-term funds for short-term assets could be best if it is as per design. So we have seen three angles, but there is one angle which I'm yet to touch. That is using short-term funds for long-term assets. Using short-term funds for long-term assets. And that can be devastating. That can kill a business. Just a moment. Just be with me. So Timareddy is asking whether bank will agree for using long-term funds to short-term assets. Timareddy, banks give long-term loans for creating short-term assets. Banks will be giving long-term loans for supporting short-term assets. They call it as a long-term loan for shoring up of net working capital. Okay. So banks, they do support, they do encourage, because they are also aware that using long-term funds for short-term asset will actually increase the liquidity, will give a lot of breather for the business. Okay. Right. Now listen, what I was saying is, never ever a business should use its short-term funds for long-term purpose. Never ever. Let me just change all these numbers. I'll give you a scenario where the short-term funds are being used for long-term purpose, and let's see what kind of consequence it is going to have. Let's say a business has raised a short-term fund of 40 crore, long-term fund of 40 crore. Okay. And out of this 40, they have used, let's say, 35 crore. Look, out of 40, they have used 35 crore for short-term assets and 45 crore of long-term asset has been created. It means both sides, total is 80 crore. Okay. Now, if you see, this business has created a long-term asset of 45 crore. How they have created this 45 crore? They have created this 45 crore using 40 crore of long-term funds. And I think the remaining 5 crore has come over here. Yes or no? Because out of 40, only 35 has been spent over here. Out of 40 crore of short-term funds, only 35 crore has been spent over here. It means remaining 5 crore has come over here. Agree? Remaining 5 crore. That's how this 45 crore has been built. What is the source for this 45 crore? 40 crore from here, 5 crore from here. Agreed? Are you all with me? Just type with you because you are going to learn another important lesson in liquidity analysis. Okay? Yeah. So what happened now? They have created 45 crore of long-term asset using 40 crore of long-term funds, which is good. But the mistake what they have committed is they have used 5 crore of short-term fund as well. Now, this is always a problem. Why problem? Because the short-term funds are those funds that are repayable within a period of 1 year, right? Whoever have given this 40 crore, they will expect the repayment within 1 year. And imagine if this money has come from bank in the form of cash credit. Imagine this money has come from bank in the form of cash credit. Let's say the bank has given 40 crore cash credit. It means that bank will expect the borrower to have at least 53 crore of short-term asset. Yes or no? Because if the bank is giving 40 crore, they expect a higher asset. Say, for example, if a bank is giving 10 crore as cash credit facility, it means they will expect 10 divided by 0.75. That is, they will expect the current assets to be at least 13.33 crore. It means bank is going to fund only 75% of 13.33 crore as CC, which is 10 crore. It means remaining 25% they expect the business to contribute on its own. Now tell me, this bank, now put yourself as a banker. You are seeing that you have given 40 crore. You expect the corresponding assets to be at least 53 crore, but what you are seeing is the current asset is only 35 crore. What you will do in this scenario? You have given loan of 40 crore. You want this current asset to be 53 crore, but current asset is only 35 crore. What you will tell them? You will warn them. You will caution them, right? You will reduce the drawing power, or you will ask them to repay. Yes or no? You will ask them to repay. Now just imagine, you have noticed as a banker, it has come to your notice that your attention that they have drawn 40 crore, but they have only 35 crore. So because of this reason, the account will turn out to be irregular. And if the irregularity continues for 90 days, what will happen? If the irregularity continues for 90 days, what will happen? All of you, please tell me. If the irregularity continues for 90 days, this loan account will become NPA. Yes or no? It will turn NPA. Let's say you have given all the instructions to this company to make this as 53 crore, or you have given all the instructions to bring down the outstanding to match it with this level. If both the things are not happening, they are not making it as 53 crore, or for 35 crore of short-term assets, the corresponding cash make this to 53 crore. If both things are not happening, it means account will remain irregular. And if the irregularity continues for 90 days, the account will become non-performing asset. So when the account becomes non-performing asset, think of the eventualities. What are all the things that can happen? What are all the things that can happen? What the bank will do now? Bank will try to sell all these assets, yes or no? The bank will try to sell all these assets. Am I right? Because these are all the primary securities. For recovering 40 crore, they will try to sell all the 35 crore asset. So now tell me, what is the loan outstanding? 40 crore. What is the asset available? 35 crore. So what is the loss for the bank now, or loss, or say shortage? Let us not call it as loss now itself. It is shortage. What is the shortage now? Is it 5 crore? The shortage is 5 crore. Now, do you think bank will say, okay, out of 40, you have paid 35, we'll forget. Let's have good terms and relation. Do you think bank will say that? Do you think bank will say that? Bank will never say. Okay. And bank will approach the legal system to recover the remaining 5 crore. So what will be the solution? They can approach the legal system. They can approach the court of law and make a claim for remaining 5 crore. They can even ask the court to close the company. Close the company. Sarfaraz, we are looking at the terms where the collateral is restricted to the assets that are created. Okay. So what the bank will do, they want to recover the 5 crore. Let's say the collateral is not adequate to recover the 5 crore. So they will approach the legal system. They'll approach the court of law to pass the winding up order for the company. What is winding up order? Close the company. Close the company, sell the assets they have. Sell the assets. But before that, one opportunity will be given to the company. That is, before approaching the court, since the 5 crore is diverted over here, the bank will pressurize the company to somehow get that remaining 5 crore. And we know out of 40, 5 has come here, right? Yes. So let's say this 5 crore is sitting here and you try to sell this forcefully now. You try to sell this forcefully. How much you will get, do you think? Because you are trying to sell some long-term asset forcefully in the market. And when the market knows you are trying to sell something very hurriedly, do they pay premium or do they pay less than what it is actually worth? If you try to sell something forcefully because you are so desperate, you want the money, you have to settle the bankers, the bank will pay you what is less than the market value. We call it as for sale value. We call it as for sale value, less than market value. So you have diverted 5 crore over here. Let's say that 5 crore had come in for purchasing some land and you are forcefully selling that in the market at a for sale value. Let's say instead of 5 crore, you are able to get only 3.5 crore. You are able to get only 3.5 crore. Okay. So now let's come here. The loan outstanding was 40 crore, 35 crore was already paid. The shortage was 5 crore. Now out of the 5 crore, 3.5 crore has been paid. What is the shortage now? What is the shortage now? Still the shortage continues. Shortage is 1.5 crore. Shortage is 1.5 crore. Now, at this point, do you think bank will say, okay, we'll forget 1.5 crore? Do you think they will say? They cannot. They cannot say that because look, they have so much of long-term assets. Out of 45, only 5 crore has been cleared off. It means they still have 40 crore. When they have so much of asset, why the bank has to say, okay, forget about it? No, they will not. So they will approach the legal system. They will ask for winding up order. They'll ask for appointment of liquidator. So a liquidator will be appointed to sell off the assets of the company. Now, what is the asset that are at disposal of the company? Out of 45, 5 was sold already. It means the asset at disposal is 40 crore. Now, this liquidator will be appointed to sell this 40 crore for realizing how much? For realizing how much? Why liquidator was appointed here? Why liquidator was appointed here? Please tell me. Because the bank is yet to recover its 1.5 crore. Yes or no? The bank is yet to recover 1.5 crore. So the liquidator is appointed to sell the assets worth 40 crore so that the bank's shortage of 1.5 crore can be cleared. Look at here, how strange. I repeat once again, bank has given short-term fund of 40 crore. Out of that, they created only 35 crore. They diverted 5 crore. When bank came to know that, bank asked the borrower to repay. So for 40, they have paid 35. It means 40 minus 35 paid already. Still 5 crore was shortage. And bank gave ultimate pressure. So the company, they sold the diverted asset and they recovered only 3.5 crore. So out of 5 crore shortage, 3.5 crore recovered. It means shortage continued at 1.5 crore. Bank was not ready to leave. Bank approached the court of law to wind up the company, sell the existing asset. They are left with the remaining asset of 40 crore. And a liquidator was appointed to sell this 40 crore worth of asset so that they can pay the bank remaining 1.5 crore. Look, for a mere payment of 1.5 crore, this business activities are closed now. Yes or no? If a liquidator is appointed means what? Business is closed. Company is wound up. Assets possession are taken and that is being sold at some throwaway price to settle these guys. That is to settle a shortage of 1.5 crore. How costly mistake this business has done. Yes or no? The costly mistake, the amount what they have diverted is only small. Is it not? The amount what they have diverted is only 5 crore and they failed in paying only 1.5 crore. But for the default of this 1.5 crore, the business itself has come to a stage of closure. This could happen. This could happen if a business is going to divert short-term funds for long-term purpose. Are you all with me? Look how disastrous it could be. A business diverting short-term funds for long-term purpose. So never ever a business should strive to commit this mistake, because if they commit this mistake, if they commit the mistake of diverting the short-term funds for long-term purpose, and if they are not in a position to correct that in near short term, that is what I'm saying that. See here, they diverted 5 crore. Let's say within 6 months, they got some long-term funds so they can correct this mistake. Then they are safe. But many businesses, they are not in that position. And only because of that, they are diverting the short-term funds for long-term purpose. And when they commit this, they are actually marking something in their calendar. When they do this, they are marking something in their calendar. Do you know what they are marking? They are marking beginning of their end. They are marking beginning of their end. And if any of you are working in NPA department, they will know 95% of the business NPAs are because of this reason. We think that business failed because of competition, because of technology, because of product quality, because of labor issues, legal issues, political issues, geographical issues. We think like that. But only 5% of the businesses are failing because of those reasons. Remaining 95% of the businesses are actually failing because of financial mismanagement. And if you go deeper into what was that financial mismanagement, you will understand they are the culprits who have diverted short-term funds for long-term purpose. The problem with this diversion is it will be not at all visible at the time of committing the mistake, because you will never know that you are committing 5 crore from CC. I mean, you will never feel this as a grave mistake you are committing. You are just transferring 5 crore from your bank account to the seller for purchasing the land. What is the big deal in that? But look where it has landed the business, right? So it could happen to any business if they are not going to have financial planning or financial discipline. So this is the major takeaway for you in today's session. The message is very simple, subtle, clear. Never ever, never ever divert short-term funds for long-term purpose. This is applicable for both business as well as personal life. And you guys, having listened all this time, I want all of you to help me in spreading this message to others. That is, I want all of you to teach this simple understanding what you have gained now. So if you are ready to teach others, just type I will teach. Just type I will teach. And what do you have to teach them? The message is very simple. Never divert short-term funds for long-term purpose. Just type I will teach. Just type I will teach. It means you got the message, you got the essence, you got the purpose. Yes? Wonderful, wonderful. Thank you so much. And oh my God, now the time is 12:17. So we started by 11:05. And now it is 12:17. Do I have your 10 more minutes to continue? It means I think we've gone deeper into liquidity analysis. Yes, do I have 10 more minutes to continue? Yes? Okay, perfect. The next area, what I want all of you to focus is the debt equity analysis. Okay, debt equity analysis, which is actually a part of capital structure ratios. Now, look at this balance sheet, or I'll just go back and copy this balance sheet. Yeah. Let me just copy this balance sheet. Or I'll do one thing, I'll copy paste. Okay. Now look at this balance sheet. Here you have funds raised from various people, right? Funds raised from various people, that is owners, from outsiders. And those funds are deployed for various purposes. And already I gave you the classification. Here funds have come from two different sources. Earlier, I introduced those sources, right? The funds have come from owners. Funds have come from outsiders. These are all the funds that have come from owners. These are all the funds that have come from outsiders. So what is the overall funds that have come from owners, which is 10 plus 15, 25 crore. So we call it as equity. Equity is 25 crore. And what is the funds that have come from outsiders? It is 25 plus 10 plus 15. So outside liabilities, we call it as outside liabilities, which is 25 plus 10, 35, 35, 40, 50. So 50 crore. So in capital structure debt equity analysis, what we will do is we will compare the debt with equity. So look at here, this outside liabilities are considered as debt. Debt is 50 crore and owner's money is considered as equity, which is 25 crore. So 50 divided by 25, you get the value as 2. 50 divided by 25, you get the value as 2. Now let me put that here. Debt equity ratio, when the ratio is 50 divided by 25, when it is 2, we express it as 2:1. And you know what does that mean? For every 1 rupee of the equity contributed, the money contributed by the owners, this business is having a debt of 2 rupees. For every 1 rupee contributed by the owners, the business is borrowing debt of 2 rupees. It means if we say the business is raising 2 plus 1, 3 rupees, okay, if we say the business is raising 2 plus 1, 3 rupees, 2 out of 3, that is 67% is coming from debt, and 1 out of 3, that is 33% is coming from owners. Yes or no? 67% is coming from debt and 33% is coming from owners. And that's what this ratio communicates. So by looking at this ratio, we understand how much owners have invested in the business and how much this business is dependent on outsiders. Let me give you another scenario where debt equity ratio is 3:1. If the debt equity ratio is 3:1, it means if the business is raising 3 plus 1, 4 rupees, in that 3 out of 4, that is 75% is coming from owners, and 1 out of 4, that is 25%. Okay, a small correction. It's not a correction, it's a mistake. Yeah. When we say 3:1, it means this 1 rupee is coming from owners and this 3 rupees is coming from outsiders, right? So for every 1 rupee contributed by the owner, this business is borrowing 3 rupees. It means 3/4, 75% is coming in the form of borrowings and 25% is coming from owners. Okay. So now tell me, you have two scenarios in front of you. We call it as scenario 1. We call this as scenario 2. Which scenario, in your opinion, is slightly risky? Which scenario is slightly risky? Is it scenario 1 or scenario 2? Comparatively, scenario 2 is slightly risky. Why scenario 2 is slightly risky? Because here the debt dependence is high. Debt is high. And what is the problem if the business is going to have debt, high debt? The high debt is going to attract what is known as financial risk. It will attract what is known as financial risk. What do I mean by financial risk? See, when they have more debt, they are supposed to pay interest. They are supposed to pay principal, right? When they have more debt, they are supposed to pay interest and they're supposed to pay principal. Yeah. So these have to be paid irrespective of business scenario. These have to be paid irrespective of business condition. Let's say for some or the other reason, if the sales drop or cost increases, what will happen to the profit? If for some or the other reason the sales drop or cost increases, what will happen to the profit? Profit will go down. And when profit goes down, it is possible people who have given debt, they may not get back their interest, or there may be delay in principals. And if that happens, what is the outcome? If that happens, what is the eventual outcome? The eventual outcome is default. Yes or no? Because as a bank, for how many days you will wait maximum? You will wait only for 90 days. Suppliers may not even wait 90 days because they need money exactly on the promised day. If they're not going to get in another 30 or 45 days, they'll go for legal recourse. Okay, so if a business is going to have a high debt equity ratio like this, then they are attracting what is known as financial risk. It means they may not be able to pay interest and principal when their sales drops or cost goes up, because their profit will come down and that will lead to default. Here we have seen two ratios only. One is 2:1, the other one is 3:1. Actually, the ratios can go even beyond. So we have seen 2:1, we have seen 3:1. The ratios can also go up to 4:1, 5:1, right? So there are certain banks, they put a cap at this level. They say, okay, nothing beyond 3:1. Our maximum debt equity ratio, I mean, we can tolerate the customers only with the debt equity ratio of 3:1. Okay, certain banks will go up to 4:1. There are private sector banks who are ready to go up to 4:1. And 5:1 cases and all, you will see only in case of already wedded. I mean, the customer has already availed the loan And in the next year, in the subsequent years, because of their low operation, they'll get into this kind of a ratio where the bank and the customer, they somehow manage the situation. But if a new customer is approaching a bank with the debt equity ratio of 5:1, it is not going to happen. Bank will stay away, because when the ratio is 3:1, what is the outside funds? It is 75%, right? Because I told you 3/4 is outsiders funds. And when the ratio is 4:1, it means 4/5 is outsider funds. It means 80%. The business is 80% dependent on outsiders' money. And if it is going to undergo a change, okay, let's say the market is going to undergo a change, then this business will suffer. And when the ratio is 5:1 and above, we need not even think about it, because the debt portion will keep on be increasing. And this will have significant impact. This will have significant impact on the financial risk profile of the business. Actually, banks will be doing something known as credit risk rating, CRA, credit risk assessment, or credit risk rating. And let me tell you, the highest weightage is given for this debt equity analysis. Okay, banks, they won't directly call it as debt equity. They actually call it as TOL by TNW. They call it as TOL divided by TNW analysis. Yeah, Abhi, that's what I said. Banks go up to 4:1. Okay, there are banks which goes up to 4:1. There are banks who put a cap at 3:1 itself. I know there are banks who put a cap at 3:1. Certain banks go up to 4:1. It all depends on the risk appetite of the banks as well. Certain banks are ready to take risk, but do you know what they do when they go for 4:1? They charge higher interest. They charge higher interest. Okay, now what is the time now? 12:27. Shall I just extend for 10 more minutes? 10 more minutes. It's your Sunday, your lunch time. Yes? Yeah, please. Okay. So here, look, we calculated debt equity ratio something like this, 50 by 25, and we got the value as 2. And we were quite okay, because 67% has come from the borrowers, 33%, 67% is the debt they are taking, 33% is the money which the owners have brought in. But what if I tell you this reserves and surplus of 15 crore includes 5 crore arising on account of revaluation? Let's say this includes revaluation reserve. Say, for example, this 40 crore includes some 10 crore of asset, which was originally written in the books as only 5 crore. Till last year in the books, this land was written only at 5 crore. But in the current year, in the balance sheet, the company has restated the value as 10 crore, because they believe this land can be sold in the market for 10 crore. Now tell me, this 5 crore which got increased to 10 crore, and as a result, this asset value is 40 crore. Otherwise, this would have been 35 crore only. Now there is an artificial increase of 5 crore. Now this 5 crore, is it a hard cash or it is only a book entry? Is it a hard cash or only a book entry? Just tell me, is it hard cash or only a book entry? It is only a book entry, right? So if it is only a book entry, I have to knock it off. I mean, I should ideally consider the asset as 35 crore only. So if I want to remove that 5 crore from here, I should also remove it from this side. Yes or no? Yes or no? Because if I want to remove that 5 crore from here, I should also remove it from here. Can I go and reduce bank cash credit for that? Answer is no, it is real. Can I reduce supplier credit? No, he will hit me. Can I reduce term loan? No, I have already signed an agreement. So where I can go and adjust that remaining 5 crore? I can adjust that only over here. Yes or no? So this revaluation reserve is inclusive of 5 crore of, this reserves and surplus is inclusive of revaluation reserve of 5 crore, which is on account of revaluing the land. So far we were believing the owner's contribution is 10 plus 15, 25 crore. Now you tell me, is it 25 crore or 25 minus 5, 20 crore? Tell me, what is the owner's contribution? Is it 25 crore or 25 minus 5, 20? It is 20 crore only. It is 20 crore, right? So here we believed that debt is 50 crore, which is true, but we believed that owner's money equity is 25 crore, but of that I have to knock off revaluation reserve of 5 crore. So owner's money is only 20 crore. Okay. Now let me give you one more shocker. This land and, sorry, not land, this non-current asset, okay, let us say this also includes an item called goodwill. So this 40 crore is a result of multiple items, which is land, building, machinery, goodwill as well. Okay. Now, this goodwill amount is, let's say, 7.5 crore. This goodwill amount is 7.5 crore, which is included in this 40 crore. Now, just imagine the scenario where this business has defaulted the loan. So the company is unable to pay the loan. So after covering all the primary security, the bank has approached the law to take control of all other assets, sell them and get some money so that loan can be recovered. Okay. At that point, do you think the bank will be able to take control of this asset called goodwill and sell it in the market and get 7.5 crore? Do you think goodwill, is it first of all tangible? It is an intangible asset. It is an intangible asset. Okay, it is not tangible asset. And if a business has defaulted, where is the question of goodwill? First of all, you can't touch, see, feel, nothing. Okay, then you can't even sell this. It is not saleable. It is not saleable. There will be no buyer. Who will buy goodwill of a defaulted company? Even otherwise, goodwill cannot be sold in the market. Okay, so at the time of default, this is not there in existence. So I don't want to take that surprise at the time of default. I want to be prepared for that. So I want to knock off the 7.5 crore from here. And if I do that, can I adjust it against bank cash credit? Yes or no? No. Can I adjust it against supplier credit? No. Can I adjust it against term loan? No. It means I'm left only with this zone. I have to adjust it only over here. Yes or right? I can knock off this 7.5 only over here. So we came to the conclusion that equity is not 25, it is 20. Now I am asking you whether the equity is 20 crore or is it 20 minus 7.5, that is 12.5 crore. Tell me, is it 20 crore or 20 minus 7.5, 12.5 crore? It is only 12.5 crore. So what we have to do, from 20, we also have to deduct this 7.5. So we have 12.5. So what I have done here is, I have taken the capital, I have added the reserves and surplus, then I have deducted the revaluation reserve, then I also deduct the intangible asset, which is 25 crore plus, what was the, not 25, 10, yeah. Capital is 10 crore. Reserves and surplus is 15 crore, minus revaluation reserve of 5 crore, minus intangible asset of 7.5 crore. So all gave me eventually 12.5 crore. This is the equity, and I don't want to call it as equity. I'm going to call it as net worth. And this net worth was arrived after deducting the intangible item, right? So in this net worth, intangible items were knocked out. So we can give a name called tangible net worth. We can give a name called tangible net worth. Yes or no? Yeah. So this is the tangible net worth. And this debt can be called as total outside liabilities. This can be called as total outside liabilities, which is 50 crore. So now we will calculate TOL divided by TNW is 50 divided by 12.5, and that is actually 4:1. Look how things have changed. When we calculated debt equity ratio, it was superb. It was 2:1, and owners were contributing 33%, and the borrowing is only 67%. But when we refined it by knocking out the revaluation reserve, by knocking out the intangible asset which were necessary, we understood that the debt equity ratio is actually 4:1. It means what? It means the debt is actually 80%. Why it is 80%? It is 4 out of 5. and owner's contribution is only 20%, which is 1 out of 5. Now tell me, which makes more sense? Is it a plain debt equity ratio of 2:1 or the thorough comprehensive TOL by TNW of 4:1? Which makes more sense? Is it A or B? Just type A or B. Just type A or B. Okay, B makes more sense. Yes, and that's the reason banks, financial institutions, they focus more on TOL by TNW. Actually, there is also one more extended version to it, that is TOL by adjusted TNW, which we will catch up in some other session. Okay, so at this point, so how are you? How are you feeling about the session? Are you deriving value? Are you deriving the value? Are you feeling the session is useful? If yes, please type useful. Please type useful. And my dear Diamond members, do I have your permission to introduce our Diamond membership to these aspiring learners? If any Diamond members are here, please type permitted. Please type Diamond permitted so that I can introduce our Diamond membership so they can continue this learning and take their learning forward. Yes, Abhi, I mean Diamond members, please type Diamond and then type permitted. Diamond permitted. Yeah, Abhi, thank you so much for the permission. Satish, Srinivas, Ashish Kumar, Baburao. Yeah, Diamond members, please type Diamond and permitted. Ashish Kumar, thank you so much. Yeah, ideal TOL by TNW ratio can be like 2:1. Okay, Srinivas, thank you so much. Ashish, Vishal, thank you so much. Let me quickly introduce our Diamond membership program. We have a membership program called Diamond Live Membership. This membership program gives you access to 130 plus pre-recorded online courses which we have published in the domains of banking, credit, finance, accounting, costing, and so on. This membership program will give you access to 100 plus ebooks which we have published in this domain. This membership program will give you access to all the live classes we conduct. That is all the past live classes as well as all the future live classes. This membership program will give you access to all future e-publications which we come out with. So these e-publications can be in the form of courses, they can be in the form of ebooks, they can be in the form of templates, they can be in the form of test series, or they can be short lessons. Okay. So this membership will give you access to that, and it is a lifelong learning experience. And today I'm going to give you a special offer which was availed by several members last week as well. We had more than 45 members upgrading to Diamond membership last week. So I'm going to open the window for you to upgrade to Diamond membership. And for that, what you have to do is you just have to WhatsApp me 90251 00249. Okay, you have to send me a message called Sunday Diamond right now. If you do so, you will get a special offer. You will get a special offer for upgrading to Diamond membership. Yes, I'm going to give you a one-time offer, a special offer for upgrading to Diamond membership, and that too at a special offer price. And this is going to be unique for each and everyone because we will consider the fee you have paid earlier. The fee you have paid earlier, you will get additional discount. And if you are a newcomer, you are eligible for special discount as well. Okay, so I'm putting the number already here. It is 90251 00249. I've also given you the link. All of you just check the comment section. I'm giving the link. If you click the link, it will automatically open your WhatsApp and generate a message called Sunday Diamond. It will send the message. I mean, it will generate the message. You have to send the message and it will ask you whether you have enrolled in any of our courses. Please mention that. And if you're a banker, please do mention that. And you are going to get special offer. Okay. If you're joining now, you can avail the special price.